let's get started. Our first speaker is going to be Andrew Atkeson, and he's going to talk about entry and exit.
So hello, and thank you, Tom, and thank you, Barry, for having me to this conference. I want to start a timer. And to the Bank of Korea. This is my first time to Korea, and I'm enjoying it very much. So this is a paper with Andrea Eisfeld and Pierre-Olivier Weil, and I see the question connected to the discussions, actually just of the last session. Corporate bonds are traded in the over-the-counter market, as are a great many financial derivatives. These markets look quite different than the idealized Walrasian benchmark we have for markets. I want to emphasize that trade seems to go on through a network of bilateral matches with a lot of price dispersion. There's some large banks that participate as dealers in these markets. And then there's a whole bunch of potential agents, potential investors who don't participate at all. So the market in that sense is segmented. And these markets have been, the dealers in these markets have been subject to a great deal of new regulation. So one of the questions that comes up is, how does this regulation impact liquidity in these markets specifically, and then more broadly, how does it affect the overall welfare that we get out of these markets? So that is the question we really want to tackle in this paper. So the goal in the paper, it's a theory paper, but the goal is to develop a tractable model of the decision of actors to enter into an over-the-counter market, and then how they trade, how prices are formed, if there are shocks to how they might decide to exit. There'll be the positive question of, does the type of trade we see in the model look at all like the trade we see in the world? But then I think we want to emphasize our contribution is really the normative question. It's hard to address questions about the impact of regulation on dealers if we don't have a benchmark for understanding what is the social benefit that we might get, and how does that compare to the outcome of market interactions. And so our central result, or the central result I want to emphasize today, is that we've constructed this model. We think of it as a prototype, but within this model we do have an answer to that question, that the incentives that are offered to dealers to enter the market and essentially profit off the bid-ask spread or off of the price dispersion are too great relative to the social value. Whereas converse, the incentives the equilibrium outcome is offering to customers, what people we call customers, who are entering primarily to engage in net trade rather than gross trade, is too small. Okay, so that's the punchline of the paper, and the point, what I hope to get through in 20 minutes is just give you a sense of how that works, where the argument comes from, and perhaps there are more general lessons as people look at different settings for exploring this question that would come out of this analysis. Okay, so the framework is highly stylized, but by making some abstractions, we gain tractability in a way that I'd like to give you a sense of. So we start with an environment, a fundamental environment, where you have a large number, a continuum of agents, who we'll call traders, who wish to share risk and aggregate risk, but they can't do so in a Walrasian market. They'll be doing it in a particular market that I'm about to describe. Now, these traders, we think of them as being organized into little coalitions that we call banks. Within a bank, traders can fully share risk. The frictions will come across banks. And these coalitions of traders differ in two respects. One is their size, how many traders are in a bank, and the other is in their endowment of an aggregate risk, which I call omega. So there's this risky asset. They have different endowments of that. And then, of course, there's a riskless asset and the banks will be looking to trade the risky for the riskless asset so as to equalize exposure across banks. Now, This trading will be done in stages and subject to frictions. So the model has, you can think of it as 3 stages. At a first stage, each coalition of traders, each bank, sees its endowment, omega, sees its size, and makes a decision whether or not to participate in the market, to pay a fixed cost to participate in the market. Then once banks have made their decision whether or not to participate, there's some collection of banks in the market, they trade in the second stage. And they trade subject to a friction we call a trade size limit. And then after trade has occurred, the traders go home, get in their little coalitions, and see what happened to the bank post-trade and evaluate outcomes based on what happened to the bank as a whole. So the 2 key frictions that we have is at the entry stage, there's a fixed cost to enter. So the benefits of entry have to be large enough to motivate you to enter. If they're not large enough, you'll stay out, and we'll get that element of market segmentation. And then the other friction is once you're in the market, you can't, the trading is done subject to a trade size limit. This is a stylized approach of kind of approximating how directed can trade be in a way that I hope to show you in some pictures. So the image that you should have in mind is there's a set of banks, they all have, that potentially could enter, they all have different endowments of this risky asset, omega, and those different potential endowments are illustrated by the black dots. And then we can focus on one particular bank, a coalition of traders with the red omega. That's their endowment. And if they enter, the way that they trade with other banks is you send your traders out and they meet traders from other banks. So you see arrows going out from that omega and they're landing at different spots, and that's representing traders from this bank with the red omega meeting traders from banks that have different exposures, and they think about trade. And so to illustrate a particular meeting, we have a trader from Bank Omega meeting a trader from Bank Omega tilde. Omega is a lower exposure than Omega tilde, so there'll be an incentive for the trader from Bank Omega to sell insurance against this aggregate risk to the trader from Bank Omega tilde. The quantity of insurance is denoted by gamma. There, we call them swaps. But the trade size limit is in that particular bilateral meeting between representatives of these 2 different banks, the trading desks, you can think of it as, are limited to sell only a certain amount, and that's indexed by K. Okay. Now, after all these meetings and trades occur across all the banks that are in the market, the traders from this Bank Omega that we're thinking about all come back and get together, and we say, what was the result of all this trading activity? The result is we're going to move our net exposure, in terms of our exposure to the risky asset, we're going to move our net exposure from omega to what we call G of omega. So you can see the G of omega is the sum of the original exposure omega, and then the results of all the trades where N of omega tilde is the density of traders with different endowments that traders from this bank are meeting in the market. Okay, so the composition of the market, of who's in the market, is represented by that N of omega tilde. Now, we're going to assume that in all these meetings, trade is done by Nash bargaining. And Nash bargaining has 2 principles to it. One is that the trade be bilaterally efficient. So what that's going to mean is if a trader from Bank Omega meets a trader from Bank Omega tilde, then they calculate through what's going to happen in this market. If they calculate that Bank Omega will have a lower post-trade exposure than Bank Omega tilde, the representative from Bank Omega will sell up to the trade size limit, K. And if they calculate the reverse, they'll sell down to the trade size limit, negative K. And if they calculate that they're going to have the same exposure ex post, then the trade limit isn't binding, and you could implement a trade with anything in there. So that's the pattern of trade, the quantities that will be traded. And the other implication of Nash bargaining we have is the traders will split the surplus or split the gap between the marginal cost of risk bearing that each of their banks will face post-trade. And that will be the price at which that particular pair will trade. Okay? So this simple theory actually tells us, gives us a machine for saying, if you tell me what the distribution of traders in the market is, N of omega tilde, I can tell you what all the trades will be, what the post-trade exposures will be, and what all the prices will be, just from a simple calculation that actually the bilateral efficiency of trade from Nash bargaining means that the patterns that emerge in equilibrium are actually socially optimal, conditional on who enters. Okay? And what the trade size limit does is when you calculate the answer to this problem, you get a picture that looks something like this. On the x-axis, we have the original endowment of the risky asset plotted, omega. And on the y-axis, we have the post-trade exposure, G of omega. And the green dotted line is an example of how the post-trade exposure might emerge given a certain pattern of entry and omega tilde into the market. And to show how endogenously banks will act as customers or intermediaries, we start with an example. We have a bank that entered with a low omega in there. As its traders go out, they're going to have a tendency to meet more traders with exposure, ex-post exposure higher than theirs. So that representatives of that bank on net will be selling protection. They might be buying a little protection to, for the blue arrow, the people left of them, but on net they'll tend to be selling protection, and they'll be selling protection to counterparties that have a high marginal cost of risk and thus a high willingness to pay for this protection. In contrast, representatives of a middle omega bank will be tending to meet counterparties that are equally spaced on either side, so they'll have a high gross volume of trade, and in this particular example, no net trade at all. And when they're buying protection, the blue arrow, they're buying it from counterparties that have a low marginal cost of risk bearing, so they'll be buying at a low price. And the yellow arrow, when they're selling, they're dealing with counterparties that have a high marginal cost of risk bearing and are thus willing to pay a high price. And so they'll be capturing a bid-ask spread in those trades. And then, of course, by symmetry, there'll be customers at the high end who will be buying more than they sell, and they'll be having a high valuation. Now, if K is large enough, the trade will actually allow that green line to be completely flat. And that would be your Walrasian benchmark. Everybody would end up with the same marginal cost of risk bearing. Trade would all go on at one price. You'd have full risk sharing. But the K being small enough, given the pattern of entry, it means they don't quite get there. There's a bit of upward slope to that line, and that's where the dispersion in prices and this network of trade and possibilities for intermediation come from. Okay. Now, what are the incentives to engage in these different activities? Well, we find it useful to think about what is the marginal incentive of a bank to be a marginal entrant in equilibrium. And we find it useful to divide this into two components. A component that we call the competitive surplus, K, which corresponds to the gains from trade you would get if you did all of your trade at your ex-post marginal valuation. This is a concept that is analogous to standard notions of consumer or producer surplus. Consumer surplus for buyers, producer surplus for sellers. But there's a second component of the incentives to enter we call the frictional surplus, which is coming from the price dispersion. You might want to enter just to get the bid-ask spreads on a volume of transactions where you do no net trade. Okay. And the central, in some sense, the central mathematical result of the paper is that both of these incentives are U-shaped. They're high for customers with extreme endowments, and they're low in the middle for intermediaries. And this is going to give us two sets of results. When we think about the positive implications, that U-shape gives us that only the large banks are going to want to enter as dealers, okay? Because the strength of the entry incentive is weakest for banks in the middle, So if we have to pay a fixed cost to enter, we have to be large to amortize that fixed cost over a bunch of trades. Whereas then you can have medium-sized banks entering as customers as engaging in trade. And then, of course, small banks might not enter at all because they just can't cover the fixed cost. So we get some positive implications about a network of trade, price dispersion, large dealers just coming out of this simple framework. But then we want to turn to what is socially optimal? What is the difference between the incentives to enter that the market is giving versus what a social planner would give? And here's where this division of the incentives to enter into the competitive surplus and the frictional surplus is helpful. Because we can write a formula for the social value of entry. A social planner or a policymaker who thinks, just get one more bank of type omega to enter, what is the change in overall welfare? So, of course, one part of the welfare calculation is, well, you have to pay the fixed cost to entry. So that's subtracted off. But if we're doing the calculation here, we know what that cost is. Let's focus on the social gain from having that additional entrant. Well, you're going to have the competitive surplus, the producer-consumer surplus, just as you normally would in any welfare calculation. The market and the planner will evaluate that component of the gain the same way. But there's this, because of the trade is going on at dispersed prices, there's this frictional surplus that the planner and the market see differently. We'll compare formulas. Well, actually, I can do it right here, if I go backwards. In the private value, we had K of omega, which was the competitive surplus, plus 1/2 the frictional surplus. Why 1/2? Because when I engage in mass bargaining, get only 1/2 of the surplus. Okay. A planner, well, I can say it here, sees, well, there's going to be two parties and they're going to be sharing this surplus from dispersed prices. So the planner counts the full F of omega frictional surplus, but the planner also takes into account that when another bank enters, when additional traders enter, existing matches are being displaced. There's only half as many matches as there are participants in the market because it's bilateral matching. So if two new traders enter, one match has to be displaced. And so we have a 1/2 F bar, that's done at random. Half of the existing matches at random will be displaced. So that is what the social value is. And when you then compare the two, what is the gap between the social value of entry and the private value of entry at any particular omega, we have this formula. It's 1/2 F of omega minus F bar. Now I said the key thing to show was that F of omega is U-shaped. It's a mathematical statement. I couldn't show the beautiful pictures, but they're in the slides to convince you of that. But think about the implications of that. The frictional surplus is U-shaped. That means at the extremes, it's above its average level. And in the middle, it has to be below its average level. So if you look at that formula, what it's saying is, for customers, the marginal social value of entry exceeds the private value or the equilibrium value. And for dealers, the converse is true. And if you integrate across, because the average of F of omega has to be equal to F bar, on average, the volume of entry is efficient. It's just that we have the wrong mix of entry into the market. Okay. So that's the argument that I just took you through about the U-shaped and the average. All right, so what are some of the implications for that? So we have positive implications from this very simple stylized framework, but we also have a normative implication that you might want to tax dealer banks a bit, tax their entry, and subsidize the entry of customers. I joke with my co-authors that you might want to run an OTC market the same way you run a nightclub. You might want to put a bouncer outside and not let anybody who wants come in, but you control entry so as to get the proper mix of representatives of different clienteles in the nightclub so everyone can have a good time. Okay, so in conclusion, I think what we offer is a new framework for analyzing OTC derivatives markets. It's a bit between a network model and a search model. It has some positive implications it shares with both network models and search models about observed trading patterns and price dispersions. But I think what's kind of new is a simple formula for thinking about the normative implications of, does decentralized trade in these markets with frictions offer dealers the right incentives to come in and deal? And then when we think about the regulatory questions, we could ask, is regulation that's making it more costly to be a dealer moving us towards a socially optimal outcome, or perhaps are we overshooting and not having enough dealers? And so these are questions I'll turn to the discussant.
Okay, thank you. Tobias Adrian is going to discuss the paper.
So I would also like to thank the organizers for putting together a wonderful conference and for inviting me to it. So it's my pleasure to discuss the paper by Andrew Atkeson, Andrea Eisfeld, and Pierre-Olivier Weil on OTC derivatives markets. My views are my own and do not necessarily represent the views of the Federal Reserve System or the Federal Reserve Bank of New York. So the contribution of the paper is to derive a general equilibrium model that is featuring an endogenous emergence of OTC dealers. And because it's a general equilibrium model, the authors are able to derive policy recommendations based on a welfare assessment. And so, as Andrew pointed out, there are many questions, many policy questions related to dealers and to market making that are at the forefront of regulatory reforms that have been done since the financial crisis. And so having a theoretical framework to think through these issues is very, very useful. So what I'm going to do in my 10 minutes is to review the model briefly and the policy implications, and to then go over three comments. Number one, put the model into a broader perspective of alternative models of market making. How can you think theoretically about market making? And then I will show some data on OTC dealers since the financial crisis, and in particular on dealer entry and exit over time. So the model setup is basically, so I'm going to repeat a little bit what Andrew was talking about, but without showing you the math. So there's an OTC derivatives market. So in particular, there's a companion paper to the paper that Andrew was showing, which the authors are using to do an empirical study of OTC derivatives markets. And so different institutions are endowed with an additional risk exposure, and they're also different in their size. And so in this OTC market, on the one hand, institutions are coming together in order to hedge risk, and on the other hand, they are trading because they have differential margin valuations. And so this is a market that is not centralized. It's a decentralized market. So different banks are sort of like meeting other banks, and then they're doing this Nash bargaining. But it's not a centralized market in the sense of a Malaysian market. And so the main results of the paper are that there's this U-shaped entry decision of the dealers. So basically, the dealers or the banks with very large and very small initial exposures have the biggest incentive to enter into trading. So you can think of these banks as having some sort of like loan book, and then they go into the derivative market in order to hedge their interest rate risk or their credit risk. And so you have these U-shaped incentives to enter into the OTC market, but they also have a fixed entry cost. And the result of that is that very small firms don't enter into trading, and very large firms endogenously become market makers. So they have very large gross positions, but very small net positions. And then medium-sized firms are sort of like customers. So there's a core of very large dealers, and then there are smaller, medium-sized banks that are the customers. And so the welfare result is that conditional on entry, the trading is socially optimal, and dealers are socially useful in this world. However, there's excessive entry of dealers into the OTC markets. So a social planner would like to tax the dealers and subsidize the customers of the dealers, or the medium-sized banks or small banks. That's sort of like the main welfare statement. There's another part to the paper that Andrew actually didn't talk about, which is about financial crisis in some sense. So the thought experiment is that some of the banks are getting hit with an adverse shock. So what is happening in such a world? And there's something very interesting that is emerging in the paper, which are multiple equilibria. So the exit decision of the dealers are strategic complements, so that you can end up in a very bad equilibrium where you have an under-provision of dealers and sort of like a breakdown of market liquidity. So whether you end up in this bad equilibrium, so like depends on the size of the shock and the configuration of the different dealers, but it does provide a rationalization for subsidizing banks during financial crisis or for backstopping the banking system. So the paper is already forthcoming in Econometrica, so I'm not going to give so like very detailed comments about how to improve the paper. Because that's a little bit too late. So instead, I'm gonna step back a little bit and give some bigger picture comments, and in particular, confront the paper a little bit with data, just to see how the empirical predictions are holding up in the data. So when you're thinking about theoretical frameworks of market making, you can sort of like think about three alternative models. So the sort of like benchmark model that I think a lot of people are having in mind is the kind of Grossmont Stieglitz setup, where there's asymmetric information. So there's a Walrasian market, but traders have asymmetric information. And the question is, how does the market aggregate information, and how efficient is the market? And what is emergent is the Grossmont-Stieglitz paradox, which is that if markets are perfectly competitive, then nobody has an incentive to acquire information, so there must be some sort of like friction so that markets are not perfectly informationally efficient. And so this model has been used as a foundation for all of the market microstructure literature. I've done work with Hyun Shin that is a very, very different way to think about dealers. And so the way that we've been thinking about dealers is that there's some sort of like microeconomic friction, which is a kind of agency problem in between investors and the dealers, that is giving rise to a value at risk constraint. So in particular, you can think of the value at risk constraint as being a kind of incentive compatibility constraint in a moral hazard model. And so this value at risk constraint gives rise to a constraint on balance sheet capacity. And so the balance sheet capacity of the dealers is sort of like moving around over time, and this is distorting risk-taking from an aggregate point of view, or from a policy point of view. And so the main empirical prediction here is one about procyclicality of dealer balance sheets. And then the Atkeson Eisfeld-Weil paper is sort of like yet another very different approach, where there's a decentralized market and there's entry and exit of the dealers, and there's too much entry of the dealers, and hence there's sort of like too much OTC trading, OTC derivatives trading in equilibrium. So let's have a look at the data. So here I'm looking at dealer balance sheets over time. And what you can see is something extremely striking, which is that dealer balance sheets used to grow exponentially for many years. And then in the financial crisis, they stopped growing, and they haven't resumed growth since then. So the size of dealer balance sheets is sort of like stuck at $3.5 trillion. and isn't growing. Had it grown at the same rate as prior to the crisis, dealer balance sheet would now be at something like 11 trillion or something like that. Now, when you look at commercial banks also stopped growing for a little bit, but then they resumed growth very quickly after the crisis. So there seems to be something strange going on. So how can we understand that within the framework of these three alternative models of market making or of dealers? So I'm going to show you a little bit of evidence in the next 3 slides. Where I'm sort of like interpreting these models within the empirical evidence. So I'm going to look at the impact of electronification on market making, and in particular on the liquidity in OTC markets. I'm going to look at the procyclical leverage around the financial crisis, and then at OTC trading volume. So here's an index of treasury market illiquidity. So treasuries are traded by the dealers, so it's the biggest OTC market there is. And what you can see is that illiquidity is very, very low. So these treasury markets are extremely liquid. And there was sort of like a decline in illiquidity, or liquidity has increased in the early 2000s as markets have become more automated and more electronified. And so the interpretation here is that despite the fact that dealer balance sheets have stopped growing, market liquidity remains very, very high, or illiquidity is very low. Markets are very, very liquid. So there doesn't seem to be a very tight link between the dealer balance sheet and the market illiquidity. Now, another way to look at the dealer balance sheet size is to ask what kind of dealers were the ones that were growing most before the crisis. Is this somehow correlated to the collapse after the crisis? And you can see a very strong negative correlation between the growth of dealer balance sheets prior to the crisis and the collapse of dealer balance sheets after the crisis. And in particular, when you're looking at the kind of ticker symbols of these dealers, you can see that in particular European dealers entered into U.S. investment banking. They grew enormously prior to the crisis, then had big losses during the crisis, and now are retracting after the crisis. So this is sort of like one way to understand why balance sheets went up and then collapsed a lot. So this would be sort of like, consistent with the kind of framework that I've worked on with Hyun Shin. Now, when we're looking at the trading volume, so here I'm showing the trading volume for corporate bonds and treasury securities, and basically there's no downward trend. So despite the fact that dealer balance sheets have gotten a lot smaller, trading volume is fairly constant. So it's not quite clear how this balance sheet is mapping into the trading volume. So I'm running a little bit out of time, so let me show you one more plot before I finish. So I think the main thing that has happened since the financial crisis is that sort of like the size concentration of dealers has increased quite dramatically, and this would be something that the framework could talk to. Thank you.
Okay, Andy, you want to take a few minutes to respond? Please.
Well, thank you very much for that discussion. And I want to stress that I'm very interested in the role of dealer balance sheets in facilitating liquidity, and I find that a very big puzzle. I mean, obviously the framework that we did was based on like a traditional view that the dealer is just making money off a bid-ask spread, and you'd see it would have revenue, but it wouldn't really have a balance sheet. And I think that the data that you show is very striking in this exponential growth of dealer balance sheets. If you trace it back from the flow of funds, to an earlier time period, for much of post-World War II period, dealers didn't really have a balance sheet. And then we had this exponential growth and this collapse and this response. And it's very hard to make sense of what this means for liquidity. And I find it interesting, if you push earlier into history, you find the same pattern in the stock market boom and bust of 1929, that dealers essentially had no balance sheet till about 1925, Then their balance sheet went up by a factor of 9 to the peak of the market in 1929, and then they had a very painful unwinding of their balance sheets rapidly in the crash of 1929. And then after that, either regulation or being scared meant they didn't have a balance sheet. So I'm very interested in that. I think the question of the relationship between balance sheets and liquidity is first order important, and so I want to stress that for future research. And thank you for pointing that out.
Okay, great. Thank you. So we're going to move on to the next talk, which is by Dong He, about asset managers.
Good afternoon. Let me first also thank you to the organizers, to the Bank of Korea, for inviting me back to this conference series. And I'm very happy to share with you the work that has been done in the monitoring the capital markets department of the IMF on financial stability risks associated with the growth of emerging market bond funds. Now, this work is based on a team of economists, the work of a team of economists in my department, and it's reflected in the Global Financial Stability Report analysis, particularly the chapter in the April 2014 issue and April of 2015 issue of the Global Financial Stability Report. Now, if you compare the approaches that we have taken here, is very much a micro-based approach to the issue of global capital flows. So we emphasize the importance of analyzing at the micro level the behavior patterns of financial intermediaries. So if you compare this with what Philip has talked about, the macroeconomics of global capital flows, we take a bottom-up approach. Here, I would like to coin a term. It's more like the industrial organization approach to the market for global liquidity. So hopefully that's a useful way of thinking about what we are talking about here. So what has happened since the global financial crisis is a tremendous growth in the bond fund industry. So this chart basically shows the assets under management of bond funds worldwide. You can see that at the bottom, the light blue bars showed emerging market bonds. They grew very fast in 2010 and 11. Then it has since then has leveled off a bit, but it's now has become a sizable component of the assets under management globally. On the top of these bars, the deeper blue bars, those cover the other bond funds. That also include some of the emerging market bonds, which are part of a more comprehensive asset allocation. Those are not the dedicated funds to emerging markets. Now, the counterpart to this growth of assets under management, of course, is the strong issuance of both sovereign and corporate bonds in the emerging market world. At the same time, we also know that cross-border banking flows have stagnated since the financial crisis. Portfolio flows have increased strongly. And in Korea, you are familiar with the story that interbank claims have really become much less of a problem. You have learned from the crisis before that interbank credit lines were very volatile. So you have taken policy measures, for example, the imposition of financial stability levies and the limits on foreign exchange derivatives positions. But at the same time, you have also observed that Korean corporates have also resorted to issuing corporate debt in the global capital markets. So the counterpart of growth of these assets under management or financial flows intermediated by the asset management industry is an increased use of capital markets in the emerging market world. part of that, of course, has to do with the monetary policy environment. So the very strong message sent by, for example, the Fed, that dollar interest rates will remain low for long, is to create very, very strong incentives for borrowers in the emerging markets to dollarize their liabilities. So that's another part of the same story. Now, at the same time, with the growing flows, we have also seen a changing pattern of the investor base in the sense that it's on top of the institutional investors like pension funds, insurance companies, sovereign wealth funds, and central bank reserve managers. We have increasingly retail-based investors in the US and in Europe. They have started through mutual funds into exotic assets. Now they have become a bit more mainstream, like emerging market bond funds. So what you have seen here is that in terms of the bond flows, overall bond flows, they increased very significantly in 2010 and 2012, as I mentioned. But also retail-based mutual funds, they have become much more important. And now mutual fund or retail-based mutual funds, the assets under management actually have exceeded those held by institutional investors. In terms of the relative importance of institutional and mutual fund investors, they have differed somewhat across the regions as well. You can see that in East Asia, emerging Asia, the institutional investors have been less important. Certainly, this is in terms of net flows between October 2008 and September 2013, institutional investor flows have become less important than the mutual funds, both in terms of bonds and equities. This picture differs somewhat in other parts of the world. For example, in emerging Europe, the picture is quite different from emerging Asia. So why should we pay attention to the changing landscape of investor base, for example? That's because we believe, as I mentioned earlier, if you take an industrial organization view to how these markets are organized or the behavior patterns of different investors, foreign investor base does make a difference, and different investors do behave very differently. We all know that investors, they have different investment policies, they face different regulatory constraints. One simple example is to look at the taper tantrum, how investors behaved differently. So during May to June 2013, the sell-off, while institutional investors continued to add money to emerging markets, in retail-based investors, they pulled back quite sharply in that episode. So these two pictures showed the cumulative flows during that two periods. You can see that these two lines behaved quite differently. And the contrast was especially large in terms of bond funds. That's on the picture on the right. So what's special about delegated investment vehicles like mutual funds? So if we think about the behavior patterns and the incentives behind mutual funds, the organization of this particular investment market, as a small investor like you and myself, if we have $100, if we want to invest directly in a stock, we cannot diversify because of our limited capital or the size of limited capital. But if we invest in a pool of funds, we can diversify our investments into a number of different stocks. But at the same time, we have a problem in the sense that we have to ask a professional investor, like an asset manager, to manage the money for us. Then we have a problem of principal agent problem because we have asymmetric information. We cannot observe the incentives and the behavior of an asset manager in real time. Then we need to introduce some mechanisms to ensure that their incentives are better aligned with the end investors. For example, we introduce a benchmark-based evaluation. We compare this particular asset manager that I entrust with his peers. So we compared his performance as compared to the same class of investors. Now that has benefits, but it also comes with a cost, in the sense that may introduce behaviors like herding, particularly in the sell-off period. There will be strong incentives for this particular asset manager to align with his peers. So that's one problem. So we can introduce issues like herding. If this herding contributes to certain price movements, say if these flows affect price movements, that would have a second round impact. That is, for example, the run risk. Now, run risks are traditionally associated with financial intermediaries like banks, because given fixed nominal claims, you have first come, first serve basis. That would introduce incentives of runs. Why do we have such incentives in mutual funds too? Now, first of all, is that we also may have liquidity mismatches. As I mentioned earlier, given the regulatory landscape that's changing, given the monetary policy environment that's driving investors to search for yield in this very low yield environment, funds have increasingly started to invest in non-traditional assets like emerging market bonds. So this may introduce a liquidity mismatch, because some of these assets are not as liquid. For example, many of the local currency bonds in the emerging markets have limited size. The market development is not as advanced as in much larger markets like the U.S. Treasuries. So this could introduce liquidity mismatches. And such liquidity mismatches could also lead to managers sell liquid assets first. And then if you know that's what asset managers are going to do, then you would have incentives to sell too, because you know that the more the longer you wait, the larger price movements may become. There are also some specific technical issues relating to how funds are priced. For example, in the U.S., mutual funds, you know that if you sell in the morning, you wouldn't know what your sale price will be until the end of the day. The trading costs actually are borne by the funds, in the sense that trading costs of your selling first would be borne by those who sell second. So that would also create some incentives to run as quickly as possible, particularly in the downside market. So this chart basically summarizes what I have said, in the sense that we may have reasons to believe, because of the changing monetary policy environment, because of the regulatory changes in the past several years, we may have seen increasing liquidity mismatches in the mutual fund industry. You could see that the EM bond mutual funds are moving towards the northeast corner of this chart. That's where you can redeem your shares very easily. We know that most mutual funds offer daily redemption options. You can sell your shares every day, whereas the assets have become increasingly illiquid. So this is when you move from southwest to northeast corner of this chart, you may see increasing degree of liquidity mismatch. So the empirical work we have done are based on the existing literature, but we also have done additional empirical work, very intensive data work. But eventually, we try to answer three questions. There are other questions that the chapters have tried to answer, but let me focus on three questions here. First of all, what drives emerging market mutual fund flows? That would help us understand the triggers of some of these dynamics. Secondly, do such flows affect asset price dynamics? If we find evidence of that, we would have more reason to worry about unfavorable liquidity dynamics. And eventually, the third question is that do such price dynamics, if we do find such price dynamics exist, do they create systemic liquidity risks in a way for the larger market? If it's concentrated in a single fund, then we probably shouldn't be as worried. But if there are mechanisms for this to affect other funds in the same market, or even broadly to the whole emerging market asset class, via ownership concentration and herding. So here we are more interested in some of the externalities created by behavior of single asset manager, whether that would spread to other segments of the same market. So in terms of drivers of such flows, we have a very simple panel data model to check or to estimate the sensitivities of fund flows to, for example, global investor sentiment change, such as VIX. So when we see how large the change of flows to a change of VIX by one standard deviation, which is about 8.5 percentage points, you can see that mutual fund bonds are much more sensitive than mutual funds equities, and the mutual funds reactions are much, much larger than institutional investors. So institutional fund investors, both equities and bonds, they do not react as much to VIX as mutual funds do. Another piece of evidence in terms of the driver is that also we see a lot of momentum trading in the mutual funds. So this is to see the estimated coefficient for lagged country index returns. So basically, whether these flows chase after past returns, you also see a very large difference between institutional investors and mutual funds, but also between mutual fund bond funds, and equity funds. So that's what this chart shows. Now, in terms of the price impact of fund flows, so the question is, do aggregate mutual fund flows affect prices? Yes, and we find evidence for that, but particularly for smaller, less liquid markets, in particular emerging market assets and high-yield U.S. corporate bonds. But we do not find much significant effect for U.S. equities and U.S. broad bond funds. So as you know, those are much larger and more liquid asset classes. But we do see some asymmetric impact. So what it means is that we find outflows have much larger impact than inflows for emerging market bond and equity funds. Again, this asymmetric impact is not so apparent for U.S. bond and equity funds. Now, in terms of when I asked the question whether we see some externalities through concentration and herding of funds, here the first exercise we do is to take a look at the actual degree of concentration. So here we look at a 1,000 bond, emerging market bond, and look at top 5 owners, top five shareholdings of these bonds. And we draw two lines. One is as of the second quarter of 2008. Another line is as of the first quarter of 2013. So you have seen some shift of the curve from away from the origin. So the blue line lies above the red line, which basically means that there has been increase in the degree of concentration. So this is security by security. The exercise, the second exercise we do then is to look at, is there any relationship between the degree of concentration and the price impact? So in this chart, we have a ranking of the concentration from the least concentrated to the most concentrated to the right, and you can see there is a positive relationship between the degree of concentration and the change in credit spreads during the taper tantrum. So this is during the first quarter of 2013 and the second quarter of 2013. So certainly this relationship is quite obvious. Now, we also calculate a herding index. So this is a measurement of correlated trading among the funds. So you can see that the degree of herding differs also by asset classes. You could see when you move from the left to the right of the chart, the degree of herding increases. The least you see much less herding, say in the S&P 500, that's the U.S. equities, and you can see a lot of herding in the emerging market debt. So that's one observation. The other one is in terms of time-wise, as compared to the end of 2009, as of middle 2014, the degree of herding has also increased. I'm about to finish. So again, this is the same picture. It's just from take a longer sort of time series perspective. You can see that we also see more herding, and more herding among retail-based mutual funds than institutional funds. That's this picture. So what are the options, policy options, that we derive from this sort of empirical analysis? One exercise which I didn't go through is that when you think about the role of financial deepening in the emerging markets themselves, if we have deeper financial markets in the emerging markets themselves, the problem associated with herding and concentrated shareholding or the price impacts would become less of an issue. So certainly go for financial deepening through including by developing larger local investor base. We know that local investors, for example, local pension funds, they behave quite differently from foreign investors. Presumably, they have very different information sets. We can also use macroprudential policies, and this, of course, applies to both source countries and the recipient countries. The reactions may be quite different. There are issues with whether asset management industry should have better risk management practices, whether it makes sense to offer daily redemption options for asset classes, for assets that are invested in very illiquid asset classes. And eventually, for the recipient countries, of course, there are potential roles for capital flow management. I think the earlier presentations have already covered these issues. So given that I've already exceeded my time limit, so let me stop here. Thank you very much. Thank you.
So Chris Waller is going to be the discussant.
Well, I'm not sure who that guy is on the screen. He disappeared about 15 years ago. So first, I'd like to thank the organizers for allowing me to discuss the paper and be part of the conference. It's a very interesting material that we've talked about so far. So I have to have my usual disclaimer, like Tobias had, that my views don't represent any views of anybody in the Federal Reserve, and sometimes I'm not even sure they represent my own views. So this is a very thorough analysis of asset management companies and their role in the financial system. I have to tell you, I learned an awful lot reading the paper. But since what I got was Chapter 3 of this report that was published in April of this year. It's a published paper written by many people, so it's kind of difficult to discuss it in a way that has value added. Nevertheless, I'll try to add some commentary that generates some discussion. So basically the paper asks 3 fundamental questions. Does fund investment behavior affect asset prices? Kind of seems like an obvious answer, but the thing they're most concerned about are price externalities caused by fire sales, where prices fall more than probably a social planner would want them to. Then they ask what drives run risk. So if the idea was if there's a run on a mutual fund, there's a liquidation, first guys in get the value of the assets, last guys in get nothing and bear most of the cost of liquidation. And what can be done to mitigate it? And finally, does asset managers' behavior amplify risk? This is the standard kind of moral hazard risk-taking issue in terms of whether we are managing risk-taking by managers of mutual funds correctly or asset-managed funds. So the authors address all of those questions using a very broad survey. I learned more about the finance literature than I ever thought I would ever learn in my lifetime, as well as a bunch of original data work by the IMF staff. So I'll kind of go through the answers, as Dong did very briefly in the talks. The answer to the question 1 is yes, asset investment does influence asset prices. When you think about large aggregate investment flows, it's kind of not surprising that they don't. We don't typically see this in less liquid markets. There's a hand moving around the screen. In both advanced economies and emerging markets. Okay, so recently mutual funds have taken large bond positions, and the fear is that when they go to unravel these positions, this is when these price externalities, fire sales, and all sorts of other instability issues are going to arise. The answer to question 2 on the bank runs was yes, retail investors always are susceptible to flight to safety. I don't know quite how you would ever think about stopping that. First mover advantage is an issue for less liquid funds and emerging market funds, but not so much for equity funds. And this is probably the most important part I took away, was that these funds tend to do a very good job managing liquidity for exactly this reason. So they may have already solved the regulator's problem when it comes to this first mover advantage issue. And I'll answer the last question on the incentives and moral hazard is, yes, incentives do appear to be a problem. There seem to be asymmetric rewards and punishment. Bad performance doesn't really get punished very much, and good performance gets outsized compensation. So this is going to induce people to go take more risk because all they have is upside. Herd behavior is then also going to be an issue when you're benchmarking each other. So if you're really being benchmarked against a common benchmark, people are going to tend to move, and you're going to get correlated trading that wouldn't necessarily otherwise be there. So in response to all of these things, what would be the policy response? Well, not surprisingly, regulate more. Okay, for a regulator, that's going to be kind of the answer. So some of my general comments. So first, I missed a slide when I was putting these together. On the price externality, one thing I want to sort of touch on is price externalities occur because people with very different asset positions or constraints are trading in one market, and there's one price that's trying to solve all these individual problems. One way to deal with price externalities is have over-the-counter markets, because then the trades and the prices are all internalized between the trading participants. This is interesting because, and this is kind of back to Andy's paper earlier, there's been a lot of emphasis in the last 5, 6, 7 years to get trading out of over-the-counter and more into centralized exchanges. In the process, what you're doing is setting up pricing externalities, which we may not want. Now, with regards to first mover advantage, this is a classic problem in any diamond divvig bank run problem. And so one way to think about in a diamond divvig model is the contract incompleteness is people's place in the queue in a bank run is not assigned. So whoever can get there first gets it. So one of the ways to solve that problem, theoretically, is you assign positions in the queue. And this is similar to tranching. So we know that in a lot of asset-backed securities, there's tranching on risk. You can also tranche on redemption as well. And this gives seniority rights in terms of if you want to be first, you can go in and get it. If you want to be last, you got to get it at the end of the queue. And then it's priced appropriately. And then you don't have this kind of problem. The issue for these kind of funds, it may be difficult to implement this in normal times. Some general comments. Who cares about first mover advantage? I mean, I don't know why we worry about fairness in the distribution of returns from a mutual fund in stress periods. We don't normally do it. And to quote somebody who once said, finance is a contact sport. If you're worried about fairness, don't get involved. Furthermore, this is an important result. Calamaris and Kahn showed a long time ago that first mover advantage is actually important for monitoring banks. The idea that if I could get if I monitor better and have better information in a stressful period, I get in first, that's a good outcome. So you're trying to use first market advantage to actually induce better monitoring of the institutions. On excessive risk-taking, I think this is a fundamental issue, and I've been thinking about this a bit in large part because of Bill Dudley's comments more recently. If risk-taking is at the manager level, then the manager's overseers are the ones who are responsible for dealing with that because their assets and their funds are at risk. But if upper management can't do it, how are regulators going to do it? This is really just a problem about almost criminal behavior. Some London whale type trader goes out there and puts the whole firm at risk. And nobody, even the upper management, spots it. But I think the bigger issue is if excessive risk-taking is cultural. This is a theme that President Dudley of the New York Fed has taken up. What they mean by that is management actually encourage this type of behavior. There's some whispers, I don't know how much of it's true, that actually Jamie Dimon encouraged some of the behavior of the London whale. And that's a problem because then what you're talking about is corporate governance has to be changed. You have to change the culture of these firms to get this out. And Bill has actually spoken publicly on that point for large depository institutions. And finally, my big question is this. We're starting to look at the risk or systemic risk of asset-managed companies. And so the natural question is, did they contribute to the financial crisis volatility in 2007 and 2008? In other words, if there are currently major flaws in the regulatory structure for AMCs, it should have been glaring to everybody by now. We should have seen big problems in these areas manifest themselves. To my knowledge, in all my 6 years plus of going to FOMC, hearing Financial Stability Oversight Council reports, reading books on the financial crisis, I've never once heard that asset-managed funds were a problem and amplified problems in the financial crisis. So apparently the financial regulatory structure they had was adequate. But that's not kind of what the paper does. It doesn't focus on the crisis and say, where were the problems that we missed with asset-managed funds? Instead, it's more this kind of looking for some trouble in the shadows. How are these firms going to create these problems? So it's like I think of it more of a whisper cam. We're looking for the monster in the darkness that maybe isn't there. So that's my point. If these problems were not apparent during the financial crisis, then there really aren't any major problems with the regulatory framework. So then at the end, what are we left with? We're recommending more regulation onto an industry that seems to be doing fine. And we're going to recommend excessive regulation. But this is what always happens after a major financial crisis. We tend to over-respond, we over-regulate, and you might say, well, that's just the nature of the beast. But it's our job to make sure that this regulation clearly is needed. Otherwise, what we're going to end up doing is stifling financial innovation and wasting valuable social resources on unwanted and unneeded regulation. And I stopped, I think, just about on time.
Yes, very briefly. Many thanks for the questions raised. But let me first point out, I don't think it's right to say that if we did not see these problems in the 2008-2009 financial crisis, that is not something to be worried. Our job is to look indeed in the dark room, and see whether there are monsters that we should be worried about. Now, for the emerging market, actually, this has been a problem. In this part of the world, big elephants in a small pond, splashes created by a number of players, has always been a problem. Many central banks have complained about it, and that led to the effort to regulate the hedge funds, or at least attempts to regulate in part as a response to their behavior during the Asian financial crisis. So to the emerging markets, this has been a problem. It's not something that we imagined. Now, for the developed markets, recall what happened to the German bond market in the past several weeks. Since late April, at the spring meetings time of the IMF and the World Bank, bonds were trading at, let's say, 5 to 8 basis points, 10-year bond. And then what's the yield now? In the past several weeks, they have gone up, and at the moment it's about maybe, 80 basis points. So this has been a huge movement in terms of a very large and deep capital market, even in a very developed market. Now, what's the reason for that? People are actively looking at it, but one reason one can worry about is that market liquidity has been very much affected by the change in the market structure. May not necessarily be a problem with mutual funds, but there are issues with dealer balance sheets, with correlated trading, with one-directional movements of positions. So I think, at this stage, let me stop here just to say that these are the issues that I think central banks and the regulators are very much worried about. And it is our job to, at least to have, in this chapter, we have attempted to provide some quantities, sense of quantities and importance of these effects that have been pretty much talked about in quantitative terms. So we hope that's a useful exercise. All right, thank you.
Okay, great. So how about I solicit questions from you? Yes.
Thank you, Dr. He, for your very essential stylizing the fact regarding capital flows and their impacts on emerging market economy. I especially thank you for it because Korea is one of the emerging market economy which had opened its capital account almost fully. Your finding about the effect of capital financial flow, the aggregate mutual fund flows having effect on prices only in emerging market effect, and its outflows, their outflows also have negative effect on the market in the emerging market economies only. So the asymmetry implies very important consequences, I think. As maybe with Dr. Macaulay and you have stylized the relationship between central banks in emerging market economy and the foreign investors. When they bring capital into the economy, they affect, their action by itself increases the price of bond and the stocks. And so the capital eventually ends up in many cases, not always, but very likely to end up in the balance sheet of a central bank as a foreign reserves. And that is only during normal times. During crisis time, it is reversed. They can take advantage of the first movers by selling their bonds, local bonds, at a high price and purchasing dollar at, I think, low price. So you termed it as a asymmetric asset swapping. And it describes the full cycle of the foreign funds in Korea. They always purchase, not always, but they tend to purchase the bonds and equity at a low price and sell it at high price. So, and the central bank, even though they did not intend, they ends up helping them to realize their profits without much taking risks. So this kind of asymmetry, I think, is I think something we need to pay for learning how to swim without. If you want to learn swim, you need to get into the water, even though you are risking your life by drowning yourself. So I'd like to hear more about how Korea can proceed from here to the advanced economy stage, like in Australia and Canada. Thank you.
Do you want to respond to that now, since it was directed at you?
Very, very quickly, I think, of course, your question is specific on Korea. I'm not in a position to offer very good advice on Korea per se, but broadly, I think the question of what is the optimal degree of financial globalization, we are still exploring. I don't think we have a good answer to that. We believe there are important benefits to financial globalization that allows the global financial system to operate at a much higher efficiency level. It also allows emerging markets to take advantages of being part of the global financial system. But of course, the trick is to balance the costs and the benefits. The costs we have seen are tangible. Korea itself experienced problems with short-term bank debt. And as I mentioned earlier, that you have successfully sort of changed the mix of the capital flows. So the question is that, do we have newer risks associated even with portfolio flows? It's not, I don't think it's an issue of avoiding such flows. It's rather to think whether there are ways of managing them appropriately to your own advantage. That's the trick.
Thank you. In the last line of the write-up here for the topic, it says, this session may in addition discuss the effects of interest rate normalization on asset prices and inflation with special reference to debt overhangs. And we've had no mention of the fact that the financial sector in the advanced market economies appears to, the price valuations appear to bear very little relationship to what's actually going on in the real economy. So equity prices very, very high, negative bond rates out to 10 years, spreads compressed. I guess my question, maybe first to Tobias, but to the whole panel, is how do you see the end game? And then perhaps in turn, what might the end game in the advanced market economies mean for emerging markets?
Yes, back there. Thanks.
Hello. This is a question, I guess, mainly for Professor Atkeson. Apologies if I misunderstood this point, but I think that one of the implications of your paper is that if we try to create a regulation that aims at reducing the risk of a too-big-to-fail bank, we might be not encouraging the creation of market makers, intermediaries. So I guess the question is, how can we start thinking about bank size endogenously? In other words, understanding not only why large banks are becoming intermediaries, but what are the fundamental causes, perhaps cost structure that is causing a bank to become both large and an intermediary, and as Tobias was pointing out, also creating high concentration in the market. Thank you.
Okay, thank you. Elaine?
Also a question on OTC markets. So first of all, how central do we think the role of asymmetric information is in OTC market in practice? And the fact that, so if you are a big player, that also means that you get to observe a lot more order flows than if you are a small player, and that you can actually use that in your trade. So that's another interpretation of, the centrality of large players in OTC markets. And by not having that in the model, how much do we think we're actually missing? One question. The second question is, why OTC market then? If we can get rid of these search frictions, so and put everybody on either a CCP or a market, so what's the advantage of OTC market for you? Why should we have those things?
Do I see anybody else? So why don't you take some time to respond?
So I'll try to get to both of these questions. Certainly in the last couple of decades, this feature of large banks being dealers has really been quite striking. But my impression is in a longer historical time period, say 150 years, that's large in terms of balance sheet hasn't been the case. And so I think that there's really a fundamental question to be asked about what is the technology for making money as a dealer bank? Is a balance sheet essential? Because now they will definitely tell you that liquidity regulation, capital regulation, Dodd-Frank regulations that say they have to justify the inventories they're holding for market maker are an additional cost for them to make markets, and they're not so happy about making markets, and they might think of withdrawing if these regulations continue. So, I think there we would share a view that they're speaking the avenue by which regulation is impacting their costs is through the balance sheet. And I take those statements, there they are, and I think as regulators or economists, it's our job to learn to make sense of them, and I would be inclined to do that. Tobias has made a lot of progress on that, but in a broader kind of historical context, because it kind of hasn't always been that way, and I'm kind of curious as an academic why not. Now, I think about, I can connect the argument about asymmetric information. My original role, and perhaps naive role, is market makers make money off of their price advantage, and if we have it from a mechanical friction. You could have a price advantage because I know the order flow. But what I mean by make money is if there's a lot of transactions going on, you make a bunch of money, and at a time when there's not a lot of transactions going on, you don't make so much money, and it would show up on your income statement. And it's not necessarily so much on your balance sheet. But if you actually, if you take like Goldman Sachs' annual report from 1996 to 2007, their total assets grow by a factor of 10. And if you take the revenue they're earning in the portion of their business that they call the institutional clients group, which is what you would associate with market making, it just grows right with it. It's about 250 basis points of assets as it grows by a factor of 10. And so you look at that and go, this looks like a fixed coefficients technology. I got a balance sheet, I make money. But then when you break the revenue down into like what's coming from commissions, if you use the focus reports, what's coming from commissions, what's coming from what they report to the SEC as trading gains, what's coming from this, those are all flat. And there's this category called other revenue that's doing all the growing. So when I say, I mean, perhaps somebody from the SEC would know the details, or an investment banker who was willing to tell us would tell us how it is that they're making money. But at least for me, maybe I'm still too naive, I think it's kind of a mystery as to how it is that they're using their balance sheets to make money. And so I've sort of sidestepped your question whether the information is search or asymmetric information. Because I think a lot of models based on kind of transaction volume as a motivation for making money will end up having the same types of problems that, the gap between social and marginal things that we were talking about, whereas the balance sheet might be different. Now you ask, why an OTC market? So this is a preview, I guess, of coming attractions. Let's imagine the world has that there is a cost of getting involved in asset markets. It's just, I have to learn about it. I'm a customer. There's a cost. If you set up an exchange, that's great for everybody who's like paid that cost, because then they get to trade at the best prices, and they're all enthusiastic. BlackRock would be all enthusiastic about that because they know how to operate in every market. But then there's nobody who has an incentive to go out and help other people participate. So that's not in our model, but a lot of what dealers do is they have sales forces that get up and try to teach somebody about these new markets, and they pay their salesmen to get customers excited about figuring out how to trade these new CDSs or some kind of obscure thing. And the over-the-counter market is a framework that gives them an opportunity to make money to pay for the sales force. And that may have a social gain because it may, in the end, lead to a broader market. Whereas if you just set up an exchange, you might find no one there willing to participate. So a preview of coming attractions, this will come in work maybe in a year's time.
That's great. Does anybody want to say anything more, perhaps about Bill's the session may, in addition, discuss effects of interest rates on asset prices? You do?
Just, I don't know whether it would be useful, but my own thoughts on this question is that at the moment, of course, this very low yield in the major currency markets are both outcome of both policy intentions. Part of that is intended by the central banks through the asset purchasing programs. But there are also, of course, important dynamics going on in the financial sector itself. As we discussed briefly yesterday over dinner, after dinner, that, for example, life insurance industries, they have very strong incentives in this sort of low interest environment to go even further into longer dated durations. So those assets, the yield will be depressed even further. Now, in such a low interest environment, in the exit phase, one extremely difficult scenario is to think what will happen on the way out. The impact will be asymmetric. There are various mechanisms at work. So the exit is unlikely to be smooth. It's going to be very bumpy, and also yield can shoot up very sharply. That would have a lot of consequences. Where would that end up with? That's very difficult to answer, because at the moment there are lots of uncertainties. What's the new normal? What's the new neutral rate? How low is the current interest rate too low? That depends on where you think the new normal will be. There is a lot of debate on that, whether we have secular stagnation or whether we are going to return normal once the debt overhang is overcome. So those are the uncertainties that would contribute to also market volatility. So I think we have all sorts of reasons to believe, including the mechanisms we have just gone through, that would contribute to financial stability risks ahead during policy normalization.
Okay. So I think I'd like to thank the speakers and the discussants and the audience for the questions. And that's the end of this session. I'll turn it over.